What is the feeling like in Australia? Like in New Zealand, interest rates are starting to come down, starting to feel quite optimistic about next year. Maybe the worst is hopefully past us. What is the feeling like in Australia?
Regarding interest rates, the market's pricing in, a February, March type rate cut, but it's going to be a slow one. They're talking 25% basis points. Look, in terms of property, most people I know in the industry are expecting a boom year. So the minute that rate drops, even if it's not large, it's going to be enough to create a pretty big sugar hit and a rush towards now's the time to get in because you've missed the best time. So.
On to tonight's webinar off the back of a long weekend.
Yeah, no, 3 days. How good?
I don't know if it's the best time for a webinar or the worst time for a webinar, but we'll find out soon.
Yeah.
So we'll just let everybody kind of slowly start to drip in. Now, we'll do some proper introductions in a second. Just very quickly, James and Mike from Lighthouse, and we've got Scott O'Neill straight off the plane from Sydney. Welcome, Scott.
Thank you.
I feel like I'm outnumbered a little bit next to the two Australians.
Yeah,
especially as the banker.
But to be fair, mate, you did do a stint on the GC with your frosted tip, so you're pretty much Australian. Now, I think we've got about 930 people registered. Question is, how many people do you think will actually show up tonight? What is like the conversion rate?
I mean, it's a Tuesday night. It's after a long weekend. So, there might be a bit of variance there. But hey, what better time to talk about commercial property?
Yeah. So should we give it a minute or you reckon we just jump into it?
I reckon we probably give it a minute or two. People are still trickling in. So while we're doing that, we're talking about commercial property in New Zealand. Obviously, Scott, your all things commercial property Australia. How are things looking in the Australian market at the moment? What are the types of discussions you're having?
Yeah, good question. Well, what we're finding in Australia is it's a big variable market. So office is still kind of finding its feet. Industrial, that's as hot as we've ever seen. Industrial vacancy rates, it's still close to record level. Lows, and retail's in between, depending on the type of retail. But people are bullish there. Like the stock is still about 75% down from 2022 peaks. So that does have a big impact on the amount to buy. So we've got pretty long waiting lists for clients over there, and that's always it's a good thing about a market. You don't want too much stock, but there's a lot of people trying to get in, and that's one of the other reasons I've been kind of mentioning New Zealand a bit because there's really good deals here to be had, and you might have to wait six months plus for a type of good commercial property in Australia, especially in the sub 2 mil range.
And that's why I'm excited about the webinar tonight because so checks and balances, we've done Lighthouse, we've done a lot of I'm sorry, Ravi, there's no way I can read that from here. If you want me to read
I can't read it.
You might as well just tell us. Tell us where. Okay, cool. The thing I like about this is we've had like more and more clients come to us wanting to talk about commercial property, and it's just an area where we've kind of let the customer kind of lead if it's something that they're more interested in. But you can quite clearly, I know you haven't been in the New Zealand market for very long, but there is definitely a gap in terms of people want to talk about. So it should be really interesting to see what we talk about tonight.
Yeah, and I look forward to the Q&As that we get from this because that's generally the best way of learning and getting questions done. And I am seeing it. There is a trend, and it happened in Australia 10 years ago when people just started, needing yield, to help retire them. And when the growth prospects aren't as great with residential, it then pushes even more people towards commercial. So, I think the times now you've got a rapidly dropping interest rate environment, which I wish we had something similar in Australia.
I mean, we did have a rapidly increasing interest rate environment as well. So we've been through a bit of pain.
Before we jump into it, just very quickly, I'm keen to, just very quickly, what is the feeling like in Australia? Like in New Zealand, interest rates are starting to come down, starting to feel quite optimistic about next year. Maybe the worst is hopefully past us. What is the feeling like in Australia?
Regarding interest rates, the market's pricing in, a February, March type rate cut, but it's going to be a slow one. They're talking 25% basis points. Look, in terms of property, most people I know in the industry are expecting a boom year. So the minute that rate drops, even if it's not large, it's going to be enough to create a pretty big sugar hit and a rush towards now's the time to get in because you've missed the best time. So the longer that's pushed out, the better, I think, from a buyer point of view. And, because the rate cut will come eventually. I don't care if it comes in November or February. It just gives us more time to act before. So it's pretty bullish over there, and it's off low stock. We've had the same immigration boom that you guys have had. I think there's over 1 million new people. We haven't built enough. It's pretty crazy what's happened. So it's going to reflect an upward trend in prices, no doubt.
Awesome. Well, let's weave that into the conversation. Let's kick it off and get right into it. So for those that have just joined us, we're back in your life with another webinar tonight. We're also going to have Scott join us for a couple of podcasts tomorrow. So if you're not subscribing to the YouTube channel or to us on Spotify or Apple, make sure not to miss those. Myself, James, Wealth Director, Mike, Mortgage Director. Hopefully you've seen us around before at Lighthouse. We'll explain what we're all about. But Mike, it's not our show tonight.
It's really not. I was saying to James, we've got the perfect mix here. James knows almost nothing about commercial property. I know a little bit. We've got an expert. So we get to ask all the questions. However, we are really keen to get the Q&A section popping. So if you have questions while we're going through it, make sure you put them in the Q&A section. You can ask anonymously as well. So Ravi, do you want to bring up the slides?
Awesome. So like Mike said, we say, Scott, we like to talk for 30, 40 minutes. We'll probably blow out a little bit. So we're going to run through some information tonight. Then as we go, try the best to use the Q&A function opposed to the chat function, just so we don't miss the questions. And then we'll answer as many questions as we can. We've got an 8:30 booking for dinner, but if we got to push that out for you, so be it.
Cool. So Lighthouse, we have a pretty simple equation to grow yourself to financial freedom. And that is education plus action with a little bit of time equals financial freedom, right? And you've probably heard me say this before. If this was the action piece, that would be great. However, it's not. This is just the education piece. You will hear us talking about taking action tonight. This is going to be specifically focused on commercial property. And if you are thinking, you know what? I do want to have a chat about commercial property. I think I've got the equity. I want to give it a go. Make sure you reach out to the team at Rethink. We'll drop some links in the chat section as well.
Yeah. And the thing I love about this tonight is it's kind of like diet and exercise, right? Like there's 1,000 ways you can go about it. You can do shares, you can do resi, you can build businesses, or you can do commercial. And it's just more information to, decide which way you want to go. In terms of the numbers of Lighthouse, this is our vanity slides. We've got 4,000 clients across the country, 900 property settled. I think Mike did most of those over the past few weeks with the OCR dropping, and over $50 million in FUM. That number probably needs a little bit of an update. Next slide, please, Ravi.
Oh, so both James and I are financial advisors, so I do have to give a bit of a disclaimer here. This is not personalized financial advice. We are just talking in general terms. If you start asking us questions in the Q&A section of, I earn X, my partner earns Y, we have this much equity, what commercial property should I buy? We probably can't give you that advice on this call. That would be something you'd want to book in, maybe with the Rethink guys, and just have that discussion.
Surely, Scott, you won't sit on the fence.
No, you get straight. Here it is.
Yeah, bit of both.
225 Church Street, Onehunga. You've got to get this one.
Yeah. Awesome. So tonight we're just talking beforehand. So we've got quite a lot of information tonight. We're going to talk about exploring, the commercial property market in New Zealand, which we haven't really done that much before. Scott's going to take us through all of that, the difference between Australia and New Zealand, and safe to say that they're probably at quite different places right now. We're going to talk about the fundamentals of commercial property. I'm sure we'll get Mike talking about the lending aspect at some point of it today.
Yep.
The strategies for success around commercial property as well, and then lots of Q&A. And I think the thing that I really enjoy about having Scott here is we said to Scott, let's do a webinar. And you're like, nah, mate, I'm jumping on a plane. We're doing this in person. And you have lots of people wax on about, I'm an expert in the industry. I know exactly what I'm talking about. This man's actually done it. He's built over $100 million commercial property portfolio himself, plus building the largest commercial buyers agency in the country. So we couldn't have a more perfect person to talk us through it.
Oh, thanks for the intro, guys. So, look, just real quickly about Rethink. There's obviously a lot of new listeners here. We've been around since it's 9.5 years now, so nearly 10 years in business. A lot's changed in that 10 years, but interestingly, back in that 2014-15 era, it felt quite similar in Australia to what it did with New Zealand right now. We're coming in to a market that feels fairly wouldn't say cold, but they're new to commercial property. They're like, it's not a mainstream asset class. Like you've probably all owned some portion of commercial real estate in a fund, or if we've got super funds in Australia, and you've got to anyone that's sort of got exposure to commercial is generally not from direct investing. So we introduced to the masses essentially the direct investing model to Australia. There's obviously, like when I first started, it was mostly owner occupiers. There were no real commercial buyers agencies. There weren't many books or anything like on that. So I know, and I struggled as an investor, and that's kind of how I've navigated the business, because I filled the gaps that I had when I was buying back in 2015, my first commercial property. And I remember the only information I could get was from sales agents and leasing managers.
Yeah.
And they're not representing me.
Yeah, they're not really on your side, eh?
Yeah. They help, but you really got to kind of take the risk on your own. And now there's a lot of great resources, podcasts talked about. Tens of thousands of investors have now purchased commercial properties. So the forums are a lot more lit up now on the topic. And it's really good. To date, we've helped over 5,000 clients purchase, 4,500, about 5 billion in commercial property. We've lost, probably another 2 or 3 billion in properties with deals that we've tried to go for and haven't. So crashed on due diligence. So, there's a lot of experience you get from doing all that. And, we're seeing it getting more popularity than ever. And the reason we're in New Zealand is, we've been asked a lot over the years. And 2021 was where like a lot of the people would listen to our podcast. And we found as soon as I looked at your interest rate versus the yields on offer back in 2021, I was like, that just doesn't add up. The yields were so tight. For example, good quality industrial assets in Auckland were 3.5% to 4.5% net yields, and you can get a better yield in Sydney or Melbourne. It didn't make sense, but now that's done a full reverse. We're getting deals, 6.5%, 7% in Auckland, and they're quality. They're not the risky ones, and it's the yield decompression that's happened. So, as an investor, first and foremost, I just like seeing good deals, and they're back now. And the only thing holding it back is your interest rate, but that's on a fast downward spiral. So it's like the timing of higher interest rates dropping, yields now higher. There's like the fat's back in the numbers, and that's what I'm quite excited about.
I'm probably going to jump around a bit here, but I do want to ask a question on something you just brought up. You said, here's kind of the yields we're looking at in terms of the property, but that's not the risky stuff. What do you look at when you're thinking this is a risky property versus this is stock standard, there's not too much risk here?
Look, it's all about relatability. So you will always got a plan for when the tenant leaves. So even if you buy a McDonald's, what if the McDonald's leaves? Can you convert it to another fast food, or do you have to turn it to something random? And the answer is it varies depending on every deal. So you got to buy fairly, products that can be reused, or if it's a childcare, is it an area that's always got strong demand? Is there a freehold land component that would allow future DA changes? It's extremely variable, and that's kind of why I like it. There's a lot of reward in commercial property. Like I always say that if the reward's higher, the risk is higher as well if you get it wrong. So you will make more money in this if you do it right, period. Because you're going to get similar growth rates, which we'll show you some stats later. And then the yield's 2 to 3 times better on a net basis. So it does make good numbers when you get it right.
Yeah. Cool. And that comment you made about, was it yield decompression in Auckland? What does that mean?
In New Zealand, James, New Zealand.
Yeah. So yield decompression essentially, so everyone's probably more used to the term yield compression.
Yeah.
So that's basically people are paying more for the same yield. Also, people are paying more for the same rent. So let's say you're renting 50 grand a year, and the yields and the cap rate's 5%, you'd have $1 million valuation on that 50 grand of income. If the cap rate is 7%, you'd pay $1 million for 70,000. So basically the rent is worth more or less depending on the cap rate. So it's driven by interest rates. So as interest rates drop, people can pay more, and that effectively creates capital growth. It's almost like a sugar hit. Or what it's done in the other department, people have withdrawn from the market because they can't justify the loans anymore. Fund managers have got liquidity issues. So they've basically stopped buying as much, and then the prices rise because there's always someone needing to sell, and then they've got less buyers, and basically it becomes a better buying market for us.
Yeah.
So the current market trends, What I can say is it's so similar. Oops, sorry. What I can say, it's so similar to Australia at the moment. So industrial is behaving just like it is in Australia versus New Zealand. So many of the brands exist between that. Like you know, for lack of a better analogy, it's almost like you're a different state in Australia. So it's like
if you were hoping for one New Zealand client, you just
like another WA.
Yeah.
No, but look, New Zealand is it's definitely cheaper.
Yeah.
The sentiment here is lower. Definitely. Like that's probably the biggest difference because we're coming from such a bullish market where we haven't really had a downturn unless you owned an office CBD apartment or you know, an office building. But the market is it's cheaper for a reason. People have withdrawn from it. And you know, it's because you had 5.25% percentage increases with your with the RBA, well, not the RBA, the OCR rather.
Yep.
And that's just created hurt in the market. People are selling. And it's created the opportunities we're seeing here, but people are still a little bit wary of making the first move. And it's hard because whenever you want to invest in the best possible time, it's not going to feel right. What most people will do is wait for the interest rates to, you know, drop another 1, 2, or 3. Then they'll convince themselves, oh, now's the best time, but they've already missed out 20% of the growth rate.
Yeah, and that's the comparison to residential, right? Like, very similar.
Same in the stock market. Like those who got in just after the GFC, when everything felt like the world was still crashing and burning, that's the moment to go in. But unfortunately, psychology doesn't allow that to happen easily.
Yeah, it's a lot easier to say, you know, buy low, sell high than it actually is to buy low when everyone else is going, why are you buying?
Yeah. And we are seeing it's changed. So on the ground, I was talking to our acquisition manager and he was saying basically the aggression from the vendors in terms of wanting more money is really amplified already to the point where it's almost like they want 20% more just from the first rate cut or two. And it's because they feel like they can get it. Naturally, if you're a high net worth investor who doesn't really need to sell, you're going to get more greedy. Every time the interest rate drops, it's another reason to ask for more money. So that's where it starts. It's not the buyer demand. It's actually the owners just not selling at the price they would have.
Yeah, that's the obvious thing to me is if buyers have been sitting on property they want to sell and not moving on their price, and then investors have more cash to work with, but buyers are going, actually, now interest rates are up, I'm going to keep moving this way. I'm just wondering, is that gap getting close where deals are getting done, or are they still staying apart because of the perception of the value of the property?
Yeah, it's a great question. Like the gap has narrowed. So basically a year ago, there weren't many transactions and it's starting. Interest rate changes generally create more buying opportunities because it just gets the volume of people more interested in either buying or selling. So transactions are happening, but it's definitely on the low side.
Yeah. We're kind of seeing a situation at the moment where the absolute deals where you're just getting a complete bargain that has already passed.
Yep.
And it's basically because at that first rate cut, investors who would otherwise be selling, they can see the light at the end of the tunnel. Yep. So, you know, the deals are still there. The market is still on sale. It's just that you're not getting that like Kmart, Briscoe's rock bottom, you know, flash sale price anymore. But it doesn't necessarily mean that there's nothing, you know, not good bargains out there to be had.
And I think the big flaw at the moment, you know, whatever you're looking at buying, is some people are so focused on the endorphin hit of getting a discount where they risk getting nothing.
Yeah.
While if they just pay whatever the market is, roll by 12 months is going to be a discount in hindsight, right?
Yeah. No, exactly. So yield. So I guess we'll go to the basics because there's probably a lot of listeners here that haven't really, done a university degree on commercial property.
Yeah.
So the big difference between commercial and residential is yield does have a very large impact on the valuation. When it comes to renting your residential property, if you get an extra $50 a week, it's not going to just instantly, like it will help the value 100%, but a lot of the time the owner occupiers pay the premium on the market. So they're the value, you know, that's where the value comes from, the owner occupier demand. But in commercial property, it's the yield. So in simple terms, we look at the net yield. So this is the other big thing where residential is always quoted gross yields. And it's sort of one of my pet hates in Australia because a gross yield is an irrelevant number where they haven't finished the equation.
Yeah.
Like what's
It's lazy.
Yeah.
Yeah.
So you might get a gross yield of 6%, but then you haven't paid for your insurance. You haven't paid for your maintenance.
Yeah.
Maintenance is a big one. If it's a brand new building versus an old one, that could be 10 grand, 20 grand a year difference, which completely wipes out your yield. So the other thing is, property management comes out of it.
Yeah.
Like yield, you've got to go back to the net, but no one ever will because it's just, that's a residential thing and it's been there for 100 years.
It's like running your business based off the revenue of the profit instead of the profitability. And I know Matt Harris, who's behind the camera, says revenue is vanity, profit is sanity, right? And it's just it's a vanity metric that gross, and maybe it pulls through to the end, but
but it does make a big difference. Like I see residential buyers agents in Australia quoting, "Oh, we've got a 9% gross yield, but it's a strata complex. It's one little thing." Like it's that
it's
would
got
really
a
turn
gym
to
and a pool that you got to pay for as part of the body corp. Yeah.
It could turn to a 2.1% net yield by the time you wipe all that out. But anyway, that's a rant. So we've gone. We've just got to look at net yields. So net yields for commercial property is the net income. So basically, it's the gross income minus all your expenses except for mortgage, because that's a variable cost. But it includes, if you don't have land, or every cost associated. So maintenance, if you've got insurance costs, strata, all of it needs to be taken out. So the net yield, we sometimes term it triple net. It's just after basically every cost. And leases vary. So sometimes there's gross leases, sometimes there's net leases. Doesn't bother me as long as you work it back to the net figure. So a gross lease is basically the tenant might pay more rent. So let's say they pay 130,000 income, but then there might be 30 grand of costs like your council fees and whatnot, maintenance. But a net lease would be you pay 100 grand up front, but then the tenant pays those bills for you. Or a month behind, you pay it and then they reimburse you. The net income's the same. It's just a different style of lease, essentially. So very important when you're doing your due diligence on commercial property to work out the net income, because that net income, even if it varies by 5 grand, could affect the the price by hundreds of thousands of dollars depending on the yield. So working it back, that's tip number one. Another big difference, like I'll go off this, I won't really follow these slides too much, but the leases vary massively. So you're generally going to work off longer leases, 3 to 5 years. I've seen leases up to 20 years in Australia and New Zealand. They could be your service stations, childcare, stuff like that. And the good thing about leases for commercial properties, especially like the likes of a childcare, it helps underpin some of the valuation. Because imagine you've got a childcare business, you can only operate there, and you want to sell that business at a multiple of 3 or whatever it is for that specific business. But if there's only 2 years left on the lease, they're going to be coming to you saying, I need that lease longer because it makes my business look stronger. So that's why you don't see many childcares with very short leases. Same with service stations. So, you're actually protected by the business in some cases. And then a lot of others just run on 3-year leases with 3-year options. So we say a 3 by 3 by 3. That just means it's 9 years, but it's split within 3 separate options. And it's for the tenant's benefit, not yours as the owner. But you will obviously benefit every time they renew, but they can choose to renew or not. It's there for first right of refusal. Essentially.
And do you usually include like a ratchet clause in there for the rent as well?
It varies. So ratchet clauses are very good to protect the lease from going down in rent. At the end of the day, it's really about the market rent for the area. So like if you're in like the CBD of Auckland where secondary office is falling in price, a ratchet clause might protect you, but the tenant will eventually be paying way over market rent and eventually they'll fail or try break the lease somehow. So, going back to basics, it's better off just to buy a commercial property that's in a good tight vacancy rate area. Rent growth is on the card because every time that rent grows by 4%, you get 4% automatic growth. So you can get guaranteed growth with commercial property, which you wouldn't in other asset classes.
Yeah, because one of the things I've heard as a negative to commercial property is you've got the risk of the tenant, right? And the tenant being tied to the value. And if you lose the tenant, and especially if you don't have a very large portfolio, you can be in a lot of trouble quite quickly. I guess your counter to that is if you have a quality product, somebody else will pick it up. And that's, where you start with, right?
Yeah. Look, and vacancies can and will happen. You just plan for it. There's generally pretty long lead times the tenant will give you if they're going to move, like, generally 6 months type territory. So it gives you 6 months to find a tenant. If you're bought into a growing market, that's obviously potentially an opportunity. So, for example, like industrial rents have grown double-digit returns across both countries for the last, almost last 5 years. And that means every time a tenant leaves, it's almost like another payday because you can bump the rent up 10, 20%. As soon as you sign that new lease, you'd go to a valuer and you can withdraw equity. So it doesn't mean every asset class will do that. But losing a tenant is only the end of the world if you can't find a tenant. But you just plan for it. Like, you've got to keep your buffers in place. I've lost tenants. I've had clients lose tenants. The vacancies can range from 3 to 6 months plus. But I guess the real counter to that is when you do get a tenant, they generally stay on average about nine years, we've found with our clients. So instead of losing a tenant every 12 months and then having your 4-week turnaround and, pay a letting fee, think about that. If that happened every year with residential, you lose a tenant every year. That's 4 weeks a year times 10 years. That's 40 weeks, and then whatever letting fees on top of that. Commercial property, you might lose a tenant once every 5 years or once every 10 or maybe less if you're really lucky. And, they're kind of equivalent. It's just commercial gets all the vacancy in one go, which is scary if you've got no buffers in place. And if you've got many commercial properties or buffers in place, you won't just take the first tenant that comes arrive. Like, you'll pick the right one and maybe turn it into an opportunity.
Yeah, and I think that's probably something important to touch on is the quality of the tenant can impact, the registered valuation of the property.
Yeah.
What are you looking for when you're telling your clients, here's what to look for in a tenant?
Look, it's sort of common sense to a degree. It's not common sense, it's business sense. But like, most people kind of going, yeah, that business is dodgy. It's not going to work, or we feel that's a dying industry. Like, you wouldn't go buy a Kodak shop at the moment, because
Blockbusters are out.
Exactly.
Kodak's out. Yeah.
So you can kind of, everyone's got a little bit of general knowledge on that. And obviously we're experts. We see what tenants are looking in the market. So we've got a bit of a head start. I can tell you supermarkets are expanding, like second tier ones. A lot of gyms popping up at the moment. Yeah. There's obviously medical is forever strong, and things like childcare are quite strong. Build costs have gone up, so it's been more restrictive to build good quality commercial assets. So it's very different. But look, I think you got to just understand the tenant, and that's what the due diligence phase is for. Like, we'll call the tenant up, find out if they've basically made any missed payments. Do you want to stay? Does the roof leak? Like, you ask all these questions.
What are we in for?
And they'll tell you. They'll give you enough to make an opinion.
Yeah. I like how you've given all these sensible answers with like supermarkets and medical and stuff. But your first commercial property, based off the notes got today, fish and chip shop, was it?
Fish and chip and a supermarket.
Yeah. I mean, there's always a need for the fish and chip shop, right? Like, that's as good as it gets. Mike pops up his local one pretty much just by himself.
Yeah. Well, look, food, and that was my logic. Like, people are going to eat, and that fish and chip had been in operation for like 35 years, and I bought that in Perth in a down market. I called up anyone I knew at the time about property, and they also don't buy it, and they're still there. 10 years later, the rent goes up 5% a year. It's got a really good fixed increase in it, so the rent's going up. They're still profitable. They haven't complained. They've had, I think it's a 5-year lease. And I've had it come up twice now and renewed it. So
nice.
Yeah.
Do you know the one I think about maybe like 10 years ago, you go, the best tenant I could ever possibly get is a bank. And now with all the branches closing, you go, that's not a chance. Tenant you want it at all. So.
Yeah. It is interesting when we talk to the banks about the lending side of it. They are really interested in the tenant and who is it, things that they avoid at the moment. Vape shops. They're very reluctant to have a vape shop as a tenant. High street. Stores have taken a bit of a hammering in New Zealand. You would notice even in the CBD, there's quite a bit of vacancy. So they're a little bit hesitant around that. But basically, to your point before, a bit of common sense goes a long way here. If you ever think about it, do I want this person in there? They're probably not the right one.
Yeah.
The only thing I'm struggling with that, Mike, is if they're not using a vape shop, who's funding all these vape shops? Because it's every third bloody shop.
Yeah, I know.
Yeah, so maybe just go back to the previous slide quickly, please. So this data was quite hard to get. So in Australia, when I wrote our second book, I wanted to get long-term growth rates for commercial property. And we're able to go back to 1995 in Australia because all the data out there for both countries is really aimed towards the fund manager or institutional grade assets. And that's a 5,000 square meter shed with a 5-year WALE. That's the definition. So we're not buying that. They're tens of millions of dollars for those things. So all the growth is skewed towards that top end of town, and that's influenced by fund managers buying and selling off each other. So it's not the real market. The real market, I'd say, is the under 20 mil, and that's what we commissioned a study to basically go in and get the square meter rates of thousands of examples and compare what square meter rate they were in New Zealand's case to 2005. That's as far as we could go back, and then to the end of last year. And these are the square meter rates for the average medium value compound rate over the years. So Auckland, if you look back at the value in 2021 to that number would look a lot better, but we've found they grew 4.68%. Office. Now you might think, why did office grow a lot more than industrial? It's just due to it having a lot hotter run earlier on in the piece. So the obvious, like the cycle, it's since fallen from those prices, but it's still very strong rates. There's more incentives in offices which help that valuation, which is a whole nother chapter of stuff to go into. But yeah, retail 6%. And, residential, you could see it's quite similar. And that was core logic data, I believe, from residential. So we didn't dig that data out. But the commercial stuff, you can see across the board, they're basically the rates. And office is basically the one that's gone the hardest. And, I think there's a lot of upside in industrial and retail and fringe office at the moment for upside in growth, because it is actually lagging a little bit. And that's the opportunity.
One of the things I think about in terms of maybe the challenge to get Kiwis to invest into commercial property is just the simpler something is, the easier it is to get your head around the stuff you hear around residential, like I want to be able to drive past and touch it, brick and mortar, and you're like, no, that stuff makes any sense. But like that does impact people's decision making, right? And fundamentally with residential, you go, well, somebody needs somewhere to live, pretty straightforward. But, hopefully we all have somewhere to live, right? We can relate to it. But if you go renting out a retail space or an office space or an industrial space, they are foreign for lots of people and go, this is a completely different world. Do you think that lack of understanding of, what the hell all these other options are is a really big barrier for getting people to invest?
100. I think it's the main one. Really, like once you understand this and exposed to it, it's quite exciting. The reason I didn't get it, I bought 14 residential properties before my first commercial property, and I wish I knew it a lot earlier. But there's nothing out there. It is hard to understand, and that's the default thing. People need somewhere to live, but logistics businesses need something to store. As that online world just kind of gets stronger and stronger, we see this as a very high growth market, and office is the one that you'd argue that's had the most change. But then again, like high quality, we were talking, you guys are, and myself, we're looking for good quality offices for our businesses, and it's hard to find because they're all taken. It's the dodgy red brick, old 40, 50-year-old stuff. That's going to never really fit.
Not a fan of the brick? Mate, it's granted, a little bit cold sometimes, but we're all right. Office is an interesting one, right? Like if you look at the kind of since COVID, the work from home trend, and now it's sort of, I don't know if you know, but the government's gone, everybody's got to get back in 5 days a week. Was it Amazon that was like, everybody's now getting back into the office? What is is that what is impacting office prices at the moment? How is that trend, whichever way it's heading, impacting valuations?
Well, there's a lot affecting it. So from the top end of town, the big super funds and the institutional investors from overseas are buying less, and they haven't met the market. So there's been circa 20-25% falls in most parts of CBD markets around the world, despite some of the European ones. The American ones have had the biggest falls, by the way. So San Fran's about 35% down, and there's some bloodbaths happening over there. But it's because there's too much supply. They're building a lot of new ones because people still they basically leave the old one. They pay big incentives. They fill the big new ones up. And that's the problem. And then they leave these dormant, half empty things. And they're going to have to be repurposed or something. Like they're not going to be able to retrofit them to compete with the new stock. And there's always someone wanting to pump money into a development because, again, it's super funds. There's endless money out there if they can make it stack up. And you can with incentives. And as long as it leases out, you're just going to, it's at the cost of another building at the moment.
Right. Interesting.
So why invest in commercial property? Look, there's a few reasons, and I think the cost of money falling, especially in New Zealand, is the real great opportunity that I don't think we'll see one of these opportunities as good in a long time. I liken it to almost the 2020 era. Just after COVID, there was this fear, and then the fear went because government incentives and people realized that property was valued. And it just shot up in value. I feel like it's a similar vibe. Both countries are looking to have an incredible 2025 in terms of valuation increases. Money is going to get cheaper. There's all the immigration, extra people here. The cost of building is still expensive, so there's not enough supply of good assets. But yeah, once those rates come down, and they're coming down, what is the latest prediction? Like another 0.5%.
It's pretty much priced in already by most of the major banks,
which is huge. Like we don't have that in Australia, but if we did, it would create an instant boom, and that's why they're not going to do it. I think because it'll cause more damage than what it's intended to. But that will create a lot of confidence. The owners are going to ask for more money.
Yeah,
I hope they don't, but they will. And it's just going to create a sugar hit to the market and get it back to where it was or close to, I think. So that's going to be good for both asset classes. But the reality is New Zealanders need cash flow. There's a liquidity issue in this country. I went to a UBS seminar, and that was kind of one of the big differences between the country. New Zealanders have less money in the bank as a percentage. This is like as of GDP, like you're sitting around 1.5% of GDP. Australians have about 8% cash versus GDP. So we're in that's the interest rate difference, I think.
Yeah.
So, that's going to start unraveling. We're going to basically have a quieter early 2025. And I think you guys are going to get a lot of growth. And that's the reason I'm personally looking to buy in New Zealand. I've been talking to the banks here, and that's a topic I'm sure there'll be a lot of questions for, because that's the main one I get from Australians. So I'd love you guys to jump in on that one. But yeah, the cost of new builds, like the costs of building in New Zealand has been up 41% since COVID hit. So that 41%, when you think about it, is the replacement value of every building we look at. So that actually has to be factored into the price to a degree, because the only thing that really threatens a valuation more than interest rates is supply of new builds. And right now it's pretty hard for developers to make ends meet and turn a profit margin of 15, 20%, whatever they're trying to get. So build costs going up is good for valuations long term. Rents have gone up generally across the board. It's the highest rent growth has been industrial, but we've also seen rent growth in good quality office and retail. That means there's upside in the commercial markets, and if they drop interest rates, it's going to create a more frenzied, positive business environment too. So you'll see people wanting to expand their business. They'll take that extra shop there. They'll do that franchise there. That'll feed into the vacancy rate situation. Like you said, there's a motive to get people back into the office. That will strengthen. If unemployment rises, employees will naturally lose a bit of power versus the employee and then employer rather, and then that'll make more people go in it. So office will, I don't think it's bottomed out. That's just my personal opinion, but it's getting closer to that period. And the vacancy rates across the border, pretty tight. Like I was looking at Auckland, like it's about 7% for prime office and about 17% for secondary. So you really got to understand what vacancy rates mean. But industrial is around 2% for New Zealand in Wellington, Auckland, Christchurch. Like it's very tight for the type of stuff we're looking at. Secondary industrial is the strongest subsector of the industrial market. Yeah. So really good signs.
What about, I'm surprised not to, like in terms of the ongoing management of the property, that's one I hear people wanting to go into the commercial space. I'm guessing it's very much, case by case, property versus property, but keeping the residential property manager accountable, or God forbid, trying to manage it yourself. First, is that perception right? That maybe, depending on the property, generally speaking, commercials, less admin?
Yeah, correct. I'll just use my personal circumstance. So we've got 65, my wife and I, 65 commercial tenants. About 5 of them are always causing us little hassles.
Yeah.
My 14 residential properties are, I'd say 12 of them are causing
Yeah,
issues.
yeah,
So, look, the hassles in commercial when they are bad are worse because there's just more moving parts. Like you got to negotiate fit outs, or maybe their business is struggling, and you got to maneuver around that. But then the other ones are like big corporates. Like you're dealing with an accounts payable department paying your rent, and the person paying the rent doesn't even know where that property is. Like it's so automated. Like for example, I've got Audi as a tenant, the supermarket. I wouldn't even know who to call if they didn't pay, you know?
Yeah, you should probably work that out at some point.
But a good quality commercial tenant has, I always say, they've got their own reputation, their brand is online. Like they're not going to trash your property. They're not going to treat it like a subpar asset because that's their business. And that kind of gives you more scalability to this style of investing. You don't want 100 residential tenants. You would have but you could very easily have 100 commercial if you have it done properly.
Well, one of the things I'm starting to hear in residential versus commercial is you have the same problems. It's just when it's a commercial problem, because the widget is bigger, there's more happening. It's a bigger problem, while the residential ones are more frequent happen. And if you can plan well for those in the commercial space, over a long period of time, it's fine. It's just if you don't plan well, like lots of things in life probably won't work out very well.
Correct. Yeah. And look, I find the commercial stuff, it can be sometimes frustrating because it's so complicated. So, and even signing a new lease, they go, oh, this is their square meter rate they're offering. They want 1 month's free rent. And then you got to think, oh, what's the square meter rate in that market? You've got to look it up. You've got to then talk to the lawyer to make sure the lease, it's always a lawyer discussion. So again, this is less frequent, but just not sugarcoating everything. It's more complicated. You got to know what you're doing. And when you have the right team around you, so good lawyers, good property managers, they will do it all. You're not going to have to understand commercial law, but you'll need to know how to outsource it pretty well.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
Hey, I'm looking at the time. I want to pivot. I want to talk about the lending side, because I know a lot of people are going to be thinking two things. Generally speaking, how much is one of these things going to cost me? Maybe that's a question for you, Scott. And then Mike, can I have some money, please? What is the difference between
how long's a piece of string?
How
much and how much money?
Yeah. And just give me a direct answer for once, okay, Mike? And how does it different in the lending side for resi versus commercial? So Scott, how much money do I have? Do I need 20 million bucks, or can I get away with a smaller amount for my first little purchase?
I'd say 400K.
400 grand.
Yeah. So that'll give you about enough you'll do the lending piece, but for an entry-level commercial asset with a loan. So you can get in with less, but do you want to? You need quality in this space. You're not trying to buy the cheapest chip you can find. You want the best quality asset, and they do start around that.
Yeah. So, and that's not necessarily cash in the bank, right? That might be a couple who's got maybe like a $1.5-2 million owner occupied, or for a lot of our clients at Lighthouse, residential portfolios they've been holding on to for a period of time where they have some equities. How's the lending different, Mike?
Yeah, cool. So generally speaking, and like everything in the lending, I guess for general terms here, you're looking at, for a standard commercial property, 65% LVR. There are certain instances where you can go up, and there may be certain styles of property that it is a little bit less. That can be just the location. Is it a specialist property? We've kind of talked a little bit before about, gas stations. You may find you get a little bit less on a gas station in the far-flung corner of the country, because that's just a more risky asset, right? Like if that tenant leaves, it has to be another gas station going in there, basically. And again, specifically for gas stations, there's environmental issues and things like that to consider. But for your stock standard, kind of product that you're looking at for customers to invest in, you're looking at about 65% LVR. The loan term, usually a 15-year loan term or a 5-year loan term with a 15-year amort. So basically, you can get a loan term for a commercial loan. So 5 years, but then you renew it 5 years, then you renew it 5 years again. So you get 15 years to pay it down in 5-year chunks.
And that's principal and interest.
Yep, principal and interest. You can get interest only as well. And again, they can be a little bit more flexible with the loan terms here because it's not residential lending, right? For people who are looking at the interest rates, and here's something you're always going to hear about commercial lending, right? The interest rates are astronomical. It's a pain in the ass. They give me fees, because you're comparing it to residential lending. Not the way to go here. You've got to remember when you're doing these transactions, this is a business transaction. There are going to be costs. So you're going to get fees on the lending. There might be a 1% fee from the lender. If you're using a broker, the broker might charge a fee. But again, this is the cost of doing business. This is a business transaction. Interest rates. Now, commercial interest rates work differently to residential interest rates. Well, they're kind of built a little bit differently. So generally speaking, the bank will put on a base rate, so their cost of funds. They'll put on a risk margin. And then on top of that, they'll put on just their bank margin as well. If you're looking for a good guide, I would just go the floating commercial rate, the floating residential rate. So at the moment, that's kind of mid sevens is what you're looking at for a commercial property. Again, could be a little bit more, could be a little bit less, depending on the property and the bank. But generally speaking, your floating resi rate is a pretty good guide of what that bank's going to give you.
And what about when it comes to the serviceability side? And I think this is something that got you interested in the commercial space. How does debt to income ratios and all of those components work in the commercial side?
Yeah, cool. So when you're looking for affordability, really what you're looking at is two metrics: your interest cost cover ratio and your debt cost cover ratio. So of the profit you're making, how much of that, what multiple does that cover the interest cost essentially? And that is a bare minimum of what they're going to look at. What is the interest cost cover ratio? Then they'll look at the debt cost cover ratio. So, let's say the loan cost me $50,000 per year to pay the principal and the interest, and I'm making $100,000. Obviously, that multiple is going to cover it 2 times over.
Okay. So, you didn't mention my salary at any point or a debt to income ratio.
Non-triple CFA lending, James.
Right.
So you're not necessarily going to be governed by a debt to income ratio because it's a non-triple CFA product. It's not a residential retail product. Now, here's the catch. In some instances, if you are tipping cash into this and you're using a residential property as security, you're going to be taking out funds on a residential interest rate to tip the cash in. It's the same as tipping equity in, but that was going to be on a residential interest rate. That may be included in a debt to income ratio.
Right. And this is one of the things that piqued your interest in terms of commercial property, right?
Yeah, and it's for 2 reasons. One, like when you get a certain number of properties, it becomes very complicated and drawn out. If you've got a deal in front of you, you sort of just want to do that standalone deal quickly. That's why we've got super fund lending in Australia, and it's kind of nice to a degree just to look at the super fund, not all the other stuff. But yeah, the real reason was like it was almost like the bank was warning me that going down this route, and I knew it, but I was like, I had a job, and I was like, I can.
Didn't want to listen.
Exactly, but the bank restricts you for a reason. It's not a profitable debt long term, and this is the model that we push so hard in Australia. Go acquire 50 properties. There's probably 200 buyers agents in Australia spitting that model out, and you think, how are you going to retire by doing that? And they say, oh, well, you'll sell them down. And if you sell them down, you're still sitting on a 3% gross, 5% gross yield. And
it's not great.
You're better off just sticking in some CommBank shares and getting dividends that way. But look, the real answer is a bit of both is what we believe in. So residential, super important. You can leverage more. You can fumble around and make mistakes and learn how to invest, because you don't want to be a first-time investor and then get hit by a vacancy. You'll probably never recover from that. But if you've invested in a few properties and you get how the world works with investments and that happens, you'll think how do I problem solve this? That's how you'll think, rather than, oh my God, I bought a dud.
Yeah.
That's the big difference.
And I think about quite a lot of lighthouse clients where they grow their portfolio to a certain size. And a lot of the narrative I hear, which is probably a lack of knowledge and education, is I guess I'm stuck. I might have heaps of equity, but there's nothing else that I can do. And this is going, hold up, maybe there's a different option.
I think that's the great opportunity here, because I know Kiwis are, like Australians, extremely big investors, like as a percentage of our GDP, it's quite high.
Mm.
So a lot of people out there that have bought large, underperforming portfolios, but if you've got equity in it, you can use that and you can tap in and just buy one property. It might fix the cash flow of 5 other assets in one go. Super common. You might buy a little mini supermarket with a couple of pharmacies or medical tenants on it, and that might give you 100 grand positive income. That could fix a lot of your portfolio.
The ability to purchase multiple properties with commercial properties because they are cash flow positive is an absolute game changer when you compare it to residential investment.
Really interesting. Okay. If we just jump back to the slides, I'd be keen to go through a few more points you want to hit on, Scott, and then open up for Q&A.
Yeah, I'll run through these nice and quick. But this is a very important slide because it's the facts of the numbers of the situation, which is not often spoken about. So bit of a random one. This is a case study we see a lot of people follow. Let's go buy 3 residential properties. The reason they don't buy $2.1 million of residential is the yields get lower the higher you spend. So the logic is let's spend a little bit less, spread my risk around, and I'll get a better yield. So we're using that analogy, just 3 residential properties. And then we're comparing it with just one $2 million commercial property. The reason it's not 2.1 is just a little bit more cash needed in the deposit. But you can play around with these numbers as much as you want. But I think the key metrics to look at is you can go with a little bit more LVR on the residential versus commercial. The property value, similar amount. The interest rate is going to be a little bit higher for commercial. This is an interest rate we saw quoted the other day. Doesn't mean you're all going to get 7.15. It'll vary. You're going to get slightly better rates with residential currently.
Michael guarantee it.
Yeah, pressure's on. But here's the big difference, the net yield. So, instead of getting 3% net, and that's pretty generous, to be honest, for residential, we're aiming for 7. I think we're averaging about 7.5 currently for Rethink clients. So there's potentially upside. So you're comparing 140 grand net income versus 63,000. Now, you minus your mortgage out of that, you're going to get negative, call it 20 grand for that residential portfolio versus positive 54,000. Just by converting your assets from residential to commercial will cause instant retirement for many people. They won't do that, but there is, I guess it's the picture here that you can really build incomes out of this. And, it's especially if you've got a bit of cash. So you will create, it's like building a business. That's why I built my portfolio before a business, because it gave me the safety net to create a business. And it made me level up in the risk, and because I'm a conservative engineer by nature, and I just didn't want to leave the job without a passive income. So I built that through commercial, and the rest is history. So if we go to the next slide, just looking at the numbers again, just to make it even simpler, what's $1 million of commercial versus $1 million of resi? Look, in the most standard case, we're just going through 300 grand deposit. So a lot of people are doing more LVR, like a lower deposit for residential. So there's actually downside in the residential numbers potentially. Commercial, we've got 400 grand in there. And basically you can see the numbers down the bottom. The cash flow is the real one. There's a 27,000 positive income versus a negative 3,000. Again, you can play around with the numbers and say, what if I put more cash into residential? It'll probably break even. But there's a huge difference. Like you're breaking even versus having, 2 of those is like 50 grand passive straight up. A lot of people can then work 1 day less or 2 days less a week. You're probably not going to retire from that.
And I think
gives you options.
Yeah. And if you combine the cash flow with the capital growth that we saw previously, because one of the common things we hear is, but that resi growth rate is so much better in New Zealand. In residential. And I think that's kind of one of the things we've got to look at here is actually the growth is pretty comparable across both the asset classes. So if you're getting cash flow positive and a growth, you're basically winning at both ends of the transaction.
Yeah, right. If you just go back to the capital gain rates earlier in the presentation, I think that's a really important point, because that's like a big thing about going I know. Look, Matt, you don't have to tell me that I'm not making cash on my resi portfolio, okay?
Yeah.
Look, these tears on my pillow every night will tell you that as I bleed cash. The capital gain rate is probably the really big one where, once again, you don't know what you don't know. It's unknown. But when you compare the cash flow implications to the commercial the cash flow with the capital gains, you go, well, this is quite interesting now. And this is why the starter is so
because actually
important.
there isn't a sacrifice here. I'm getting both.
Yeah, and I actually think if you really know what you're doing, you can maneuver around the economy and pick the right asset class that's outperforming. So you, just like a really good residential investor, they might go, "Oh, Christchurch is more undervalued right now." May or may not be, but you can outperform the market to a higher degree in commercial because of asset classes performing differently. And if we go to that slide with the cash flow, that large spreadsheet, I'll show you.
The engineers entered the room.
Yeah. So this is just something we like. It's a pretty simple cash flow diagram, just showing the value of money over time. So everyone always looks at year 1 or year 0, the cash flow. That's not what it stops at. Like even if you've got a 3% increasing rate, so the variables here are we're using $1 million purchase and 60% debt, and the rent's going up at 3% per annum. So what 3% per annum compounding looks like is by year 9, your yield has gone from 7 to 9.13. The value of the property is now 1.3 mil. So it's gone up 300 grand in that time. And that's just based off 3%. That like it might have gone up. It might be worth 1.5, 1.6 mil if the market's well. So you can then use that 3 to 600 grand equity, then buy another one. And you're left at that time. You see which is the cash flow less interest. So if you look at that second last column at year 9, the cash flow has grown from 26,800 to 67,647. So it's pretty significant. And obviously the economists in the room will go, "Oh, what's the value of money at that time?" Of course, there's a real inflation rate we've got to factor in. But the rent is at least keeping up or exceeding inflation, and then you've got the leveraging benefit. So the more inflation, the better when it comes to leveraging, because money is devaluing essentially. So I'll go briefly, just for the sake of keeping time brief, just 2 deals real quick that we've completed in New Zealand in the last couple of months. So we had a client, 2.5 to 3 mil brief. They wanted Auckland, and their yield preference was 6 to 7. A lot of people want 6 to 7 because it's kind of a universal or current rule where you will get a good offset of low risk, good capital growth. You don't want to. You can go out and get a 16% yield in the sticks. But as soon as that thing goes vacant, it's vacant for 5 years. There's a happy medium with the risk profile, and somewhere between 6 and 7.5 is sort of where it is at the moment. If we just go to the next page, I'll just show you the assets. So this is a warehouse in Auckland. Why I really like this deal, there's a few reasons for it. Freehold, the yield on it ended up being 6.56. Nice. We had a valuation. Well, the owner had an old valuation from 2021 or early 2022, I believe, at 4.6% net. So that's a massive variance in yield. So that's the yield decompression thing. So just by not buying that in the last 3 years, like there's huge upside. Yeah. And if interest rates drop, that might get valued at, it could get valued into the 4s again. And if that happens, we're talking several hundred grand upside for this owner. Great business. It's a heavy diesel mechanic. So they basically, they specialize in asphalt maintenance, the big equipment for the civils there. They're not going out of business. They're doing government work. They're doing private work. And even if they left, it's a shed in the middle of Auckland. There's going to be a sub 2% vacancy rate in that market. So you might wait 2 months for a tenant and have 3 choices. So the replacement value of something like this would be quite similar to the value. You're probably working off $2,500 a square meter to build a shed at the moment, plus buying the land. So we've done well on that metric. 5-year lease. We did our usual due diligence, called the tenant up, checked the building, checked the roof was good, checked the air cons. We understand the relatability of this is good. We bought hundreds, if not thousands, of industrial properties in Australia similar to this. So, very confident that we'd love 10 of these, basically. So, just high-level metrics. The client is going to collect, after a 60% debt, 53,000 clear plus growth. So not a bad year 1 equation. We go to the next slide. I'll run through that quick as well. This one is a medical center. So if you look at that picture, you can see there's a red roof one. That's a public hospital. And this one with the silver or white roof is the private hospital. So incredibly good tenant, extremely expensive fit out. they're not going anywhere.
No.
Like it's like recession-proof asset. I love these types of ones. The yield is particularly good on this. It's 7%. Their asking price was the previous one was off market. We bought this one was on market. So we do buy the odd on market deal, but we preferably try get 60 to 70% of our stuff off market. But we got them down from 4.2 mil to 3.75 mil. And the great metrics. This is a clear 100 grand passive income at the current interest rates. If interest rates drop, you could clearly see that they might have 150 grand passive income within a year or two. So these are the types of deals we look for, and that's what we're about.
I gotta say, Michael,
I can see you looking. I was just about to
say,
see you looking at me.
you
Like,
guys, we got Ravi and Mike behind the camera. So I don't know if you know this, Scott. We've just recently done this whole thing where Mike and I bought 12 units in Upper Hutt. We've got a brewery out there. You should check it out sometime. And I am definitely got the wheels going in my head. James and Mike buy a commercial property.
yeah.
Has a good ring to it. So watch this space.
Cool. All right. So time for the Q&A. I can see some questions coming in
Just
there.
before we jump into the Q&A. So I just want to do a quick piece around Scott. Your offering sits quite well within our ecosystem at Lighthouse. So we have clients come to us where they're like I want to buy like a nice owner occupied home, but I don't have any time, and then we'll send them out to a buyer's agent in the residential space. We'll have clients who want to invest into residential investment property and add value, and we'll send them to also Wolf Property. Your offering in terms of like complexity, right? You don't know what you don't know. Using a buyer's agent, to me, I would go, doing this for the first time by yourself, you'd be mad.
Yeah.
Just before we jump into the questions, if somebody is thinking about this all sounds really interesting, I would like to know more. How do they reach out to you? And I mean, I feel kind of like you've explained well enough what a buyer's agent does, but maybe just kind of a little bit around kind of the process a client goes through.
Yeah, look, simply just Google Rethink Investing NZ. That's probably the fastest way. Look, the process is we will chat to you individually. We want to find out what your risk profile is, what you've invested in. Getting to know the client's very important. We do not want to just go, here's a cookie cutter deal, go buy it. We want you to understand it. So education is part of it, but effectively a client retains us. Then we will start searching specifically for them. We've got scouts all over the country. We've got great networks of agents. The agents have really taken kindly to Rethink at the moment because a lot of them know us through Australian real estate. So it's been a pretty smooth entry. But the biggest benefit of using us is access to more stock than you'll see. And our due diligence team is my favorite part of the business. When I buy a property, I just give it to them because then they go and talk to the tenants. They go through all the tenant ledgers from 3-4 years ago. Like that's so boring, this stuff. But you need to.
So you got to do it.
Yeah. And you got to talk to councils. You got to then check, is the mezzanine council approved? Is there contamination issues? Do we get an environmental report? Is it meeting the new building standards in NZ? Like there's just, you need a team of lawyers, a due diligence guys, and there's got to be a commercial aspect that you will not know if this is your first, second or third time. I'm still learning every day, and I've done thousands of deals, and every week there's something slightly different. And go, oh, that was unique. And you just got to use someone who does this. And that's the hard bit.
Even the way you described the Taupo deal where you're like, look at the hospital situation, the private practice, the expensive fit out. Yeah. It's all the part of the story, right? In terms of whether this frames up as a good deal or not.
Yeah. Who paid for the bid out? Is there a cash incentive? Does the owner know the landlord? Why are they selling? Is there another DA coming from there? Is there a flood zone? Is the building got a useful age left in it? Doesn't need to, you can go on. There's 100-point checklist essentially.
Cool. Okay, awesome. Well, let's jump into the questions. So first one, can Australian citizens invest in NZ through their self-managed super fund? If yes, what is the process? Thanks, guys.
So this is, you can, basically, it's about getting the money over here. So this is the lending is probably the tricky bit, which you would probably have a little bit more insight on that. We haven't done a super fund loan in NZ, but it's like buying stocks. Like you can buy US stocks. Like you just need, to set up a company with a local accountant. Again, you guys are the experts there. If you
I don't know too much about the self-managed super fund loans. The last one that I had got stuck at the lawyer's stage. So to be honest, I don't know too much about that.
It'd be difficult with the loan section. You can buy it, but it'd probably be because there's only, I believe there's 5 banks and they're quite niche banks in Australia. The big 4 do not lend to super funds. As of today, I do not believe so. It's the lending.
Like I said, the last one I saw got stuck at the lawyers.
Cool. Next one, can we use corporate trust structures to purchase commercial property in NZ? How about the loan arrangement as I live in Australia?
So again, this is all these accountant questions. I would I immediately default to a couple of the locals here. So I got now 2 accountants. I got my Australian accountant and my NZ accountant. So you need I can't legally answer these questions.
Come on, Matt. You wanna pop in?
Jump in.
Yeah. Yes, you can. I gave you the opportunity at the mic, and so Matt said yes, you can. Use your corporate trust structure. I can't believe you missed the opportunity to get in front of a camera. Cool.
In terms of the loan arrangement, if you're talking about how do the guarantees work, effectively if you're purchasing under an entity, it just needs to be guaranteed in a way that if the bank may require that you provide a personal guarantee along with the asset. That's not like that in all instances, but basically the loan will be in New Zealand, the asset will be in New Zealand, and that will secure your lending.
Cool. Next question, Mike, is around LVRs. What is a typical LVR for a commercial property?
Around 60 to 65%. Can go higher. Some will be lower, but generally you're looking around that 60 to 65% mark.
Cool. Really good question for you next, Scott. What do you find after all of your experience holds people back from their first commercial property? Also, what can be some of the biggest obstacles to overcome?
Look, good question. The answer is when they're coming to us, they're generally ready to go. So there's a lot that I wouldn't see. They're just not reaching out for whatever reason. But by the time they're talking to Rethink, we've got a very, very high strike rate. They generally buy. I'd say our clients are quite educated, especially in Australia. They've had 10 years of this, feeding the algorithms chase them as soon as they click a commercial property, and then, you get peppered by all the ads. So there's a lot of good stuff out there. And the more you know, the more likely you are to buy this. This is an asset class that will excite you the more. And that's how I've always sold a property. I don't want to ever say, you need to buy this. It's a great deal. The deal should sell itself. And if you're feeling nervous about it, it's time to learn more. And then generally you'll make the own call pretty quick. But there's not many people that I talk to that are against it. The New Zealand, I'll answer it for that. It's the interest rate. That's the main reason people are holding back. Australians particularly, most Australians scoff at the interest rate when they hear it. And then I explain, look, it's coming down hard and this is the opportunity. You need some barriers to buy well. If you're going to wait for the interest rate to be 5%,
you missed it.
It's too late. You need this to buy well.
And we are expecting the interest rates to continue to drop pretty aggressively, as we've talked about quite a bit over the webinar.
Cool. And next question for you, Scott. You've answered it already. What would you consider a bad, good, and great yield for a commercial property?
Bad yield, it's dependent on the market, but I like answering direct. Anything under 5.5 is tight, but this is for both countries. It's really about the yield over a 10-year period. If there's rapid increases, or you can bump the rent up after, a lease review 6 months into the deal, or even 18 months, and it jumps from a 5 to a 7, and then that 7's got good rental growth. Your average yield over a 10-year period might be 8%. So it's not the year one yield. It's the average of the accumulation of the entire rent over the lifetime of you owning it. That's your real money in the bank. So high growth is a good thing, but we tend to guide in Australia minimum 6%, but we'll go under it for the right deal. It's probably closer to 6.5 in New Zealand. And we are thinking of rates are coming down, and there's genuine upside in that because your yields got tighter than ours. So that's the kind of elephant in the room. If that goes back to what it is, anyone that buys at a 6 is going to be sitting on a lot of equity.
I actually like the point you made before as well, as a bad yield doesn't necessarily need to be low. A 16% yield can also be a bad yield, because you're looking at it going, the risk reward trade-off here is too much for us.
Yeah, like you might buy a vape shop and the banks don't lend it. So
Yeah.
naturally a vape, it might be the same shop. It could, if that was a dentist, it could be a 6% yield, but a vape, you need to get it at an 8% because you've got to put more cash into it. So tenants will vary the yield massively.
Yeah, cool. Next question from Tom going, should I buy a 600K property now and another 600K property in 5 years, or just bite the bullet and buy a $1.2 million property now? That's probably a little bit specific. 600 grand, not going to get you very far in commercial property, right?
No, look, you're better off putting more money into commercial as a general theme, because the more you spend, the better the position of the property, the better the tenants. Like the quality will go up a lot, but 5 years is a long time in between drinks as well. So you'd miss 5 years of potential growth. So, in that case, I'd go to what you can comfortably afford, and then maybe buy with equity and future savings you've got. So getting into the market is our priority right now. It's not the only one, but like there is genuine change in the air. It's not like you're buying into a flat market and you've got all the time in the world. So I wouldn't wait for the sake of waiting.
Just a point on that from the lending perspective, a lot of the time with commercial properties, it is a little bit easier to syndicate. Just in terms of, let's say James and I go to buy a residential property as an investment. It's a loss making, generally speaking, it's cash flow negative or it's loss making. So that means that both James and I have to individually be able to service that loss and the debt. That is different with a commercial property. If James and I went to buy a commercial property, it would probably be a lot easier for us to tip our equity in and syndicate and buy it together, because it is cash flow positive and the banks look at it very differently.
Cool. You want to read the next question, Mike?
No,
I know you don't have your contacts on. I was just taking the piss out of you. How would your view of setting up a batch of accommodation units in a small town where a large capital project like a mining or government project is likely to go ahead? Would commercial investors be interested? That's probably something quite different, isn't it?
Yeah. Look, generally, they probably wouldn't be. That would be more of the development type risk profile. So I would say most commercial investors, even though we've got a higher risk tolerance than residential investors, it's still, you want the safe tenant. You want the status quo to remain. So you're not buying vacant. You want to see the tenant, see what they've been paying, how long the lease has got, and then you can quantify to the decimal point how much rent you're going to get. Sometimes for the next 5 years, because it's a scheduled increase. So that is a whole different story. For sure.
Next question from Laura is about Queenstown industrial compared with the South Island.
Look, basically all industrial right now is tight. And I've seen the stats. Like the only risk to industrial right now is build costs. I was reading this morning that they've come down for the first time in 5 years. July, the government's kind of released, it's made lending easier in that space. So there's more kind of incentives to build, and that's going to kind of release the supply a bit. So with industrial, the only thing that can threaten this incredibly strong market is if they build too much of it. So there's slight pockets in Australia where they've just built a lot of smaller ones, and it's super rare. Like this is kind of the 1% market.
Yeah.
But there's just a little bit more, and that means it takes a bit longer to find a tenant. There's owner occupiers generally demanding these properties as much as investors. Places like Perth, the owner occupiers pay up to 20% premium for a vacant shed. So you don't get a discount for a vacant shed in some markets. So there's a lot to that question, but generally Queenstown, Wellington, Auckland, Christchurch, all the slightly bigger centres are very in demand by industrial tenants.
Have you spent any time in Queenstown yet?
No, that's the next family trip.
Yeah. Look, I would just be making some excuses from a business opportunity to roll down there.
We went
last week.
We went there last week, so I'm happy to show you around. Next question: what does your ideal lease agreement look like? Do you have a preference between market rent or CPI rent reviews? How would you go about getting a property's lease increased if the lease was under the current market value?
Great question. I can see they're educated. So this is a good question, because look, I'd prefer a market rent review, because if you're buying in a good market, it's going to exceed CPI. So, places like Auckland, like it's double-digit growth for industrial. So you might have a fixed 3% increase for 3 years, but then the rent's 20% behind the market. So then you can negotiate with the tenant. You might not get the full 20 because you're still going to be commercial in your negotiations, and you might do them a favor, but you might get 10 or 15% increase, and then you're back to the 3%. So CPI is on the way down. So yeah, I don't no one's got a crystal ball. That's everyone's an economist these days because CPI is such a topical thing. But fixed is quite good. I like a 4% fixed if I had to choose it. It's not going to destroy the tenant. You've got certainty, and also CPI can be a little bit more complicated because what CPI do you use? You know, which 4 quarters do you use? Is it the Queensland CPI or is it? There's many different CPIs out there.
Yeah, cool. Next question is around owner occupied. So if I do require brick and mortar location, should I look at buying the place?
Great question. Again, it's really specific. I think you could do both. Like a lot of people make the mistake buying an owner occ and then they outgrow it. And then they've just got this kind of quasi investment / owner occ property, which sometimes it's good just to be a pure investor and create this side business which supplements your current business. Because one of the things that I've seen with a lot of my clients, because a lot of them are business owners, they have this great business and then they buy their property and then they want to sell out or they're retiring. And then they've got this property in the business valuation as well. And it could be a $5 million asset. So number one, it makes it harder for business partners to purchase into the business.
Yeah.
Number two, you kind of got to separate it eventually because most people buying a business don't want the freehold as well. And most commercial investors don't want the business. So it's kind of better to separate it generally. But if you think you're going to be there forever, it's better to pay yourself the rent. And that's a common strategy. But I've just been a pure investor. It's like setting up another business outside of the business.
I was actually going through that today with a customer where it was a storage business and freehold land, and the customer just wants the land and the guy can't separate it. And all of a sudden, my customer's looking at this going, why would I want this business? It's so far overvalued because he's just been in it for years, So it can actually create some issues down the line.
Yeah.
Awesome. Next question, Mike, is one for you. In terms of the 15-year loan term for commercial property, can this be extended? If not, how do you use the equity to jump into another property?
Yep, this can be extended. Yep. I can keep it super short, but yeah, you can extend them. Again, it is just basically you just have to reapply for the lending again, whether that's at the same bank or a different bank. Yep.
Cool. Next question for you, Scott. What are some non-common items that you run into when carrying out due diligence for potential purchase?
One property I was buying 3 years ago, it had gunpowder contamination in it from the 40s when they were manufacturing artillery. So especially in established industrial areas, there's all sorts of booby traps that you can come into because there's a history. Like they may have had petroleum on site or
asbestos. Or something.
Exactly. Yeah. And that can be held in an environmental management facility where, it's on record, and that can affect lending, insurance. The way to get around it is you soil test, get the soil samples. You check, and this goes with flooding and all sorts of detractors on a property. Check with your insurance company if it affects insurance, and check with your bank or broker if it affects finance. Because if it affects either of those, it's kind of a problem for valuations down the track. But if it doesn't affect them, maybe it's not too serious. So you can get past that.
Cool. Next question from Mitch. Scott, how do you get paid?
So we get paid on settlement. So we got full disclosure, we got a lifelong retainer. It's $2,490. So call it $2,500. And that's like a lifelong retainer. We require that because we get hundreds of people reach out for information every day. And it's amazing. That just means we're dealing with people that are really wanting to buy. So we then send deals to you one-on-one. That means there's no time limit. There's no property limit. Like you could look for 5 years if you want. But generally people end up buying one of the first 5 properties we send. And obviously different price points will have longer wait periods than higher ones. So, the lower end will be tougher because there's not much stock. But how we really make money is through the percentage fee. It's similar to a sales agent. So we get paid 1.9%. So if it's $1 million property, there's a 19 grand extra cost at settlement. So we get paid at success. For that, we do all the due diligence. It could be a 50+ page report. We don't get paid if it crashes, by the way. So we still do that report. So there is a lot of sunk costs in that from our point of view, but most do go through. And then, I guess the way to look at our fee is we model into the numbers day one. If it stacks up, it stacks up. We try and negotiate our fee, hopefully 3 to 5 times over as well. So it's just a numbers game. Like you only pay us if you think it's worth it. If not, reject the deal, move on to the next one. And 4,500 deals later in Australia, it's not a problem. And sales agents often get up to 3% just for showing a property to a few people. So it's all relative.
The other big piece is you're an insurance policy, right? Look, go save your $19,000, bet the luck, hope it works out. But the amount of people who do decide to kind of DIY it when they have no idea what they're doing, those kind of random due diligence things where you're testing the soil, right? Like you're an insurance policy, 1, to make sure you take actions to sitting on the fence, 2, to make sure that you don't end up with a lemon at the end of it.
Yeah, exactly.
Cool. Next question. This is a really good one. If you wanted to, Scott, hypothetically, you're starting from scratch, you want to scale your commercial property portfolio as fast as you can. I'm guessing you're going to need some cash to do it, but what's your strategy going to be? How would you go about it if you're starting from day one?
Great question. Number one, you got to maintain a yield. So this is why I don't go buy 4% yielding assets, because I want to scale it so we can buy lots of them. So when you've got a self-sustaining portfolio, that's the key word, self-sustaining. It's got a cash flow positive situation and it gets better every year. You need growth. You need good enough day one cash flow, and the bank should keep lending to you, assuming you got the deposit. I would mix it between asset classes. Like even though 60% of Rethink's client properties have been industrial, I'm actually more weighted towards over 60% in retail. So I love mini shopping centers, like neighborhood shopping centers specifically. We're not going to the CBD and buying vape shops. So retail is very different to, the supermarket or the little like medical is a version of retail potentially as well, like mortgage businesses in the suburbs for the shop front. Like they're great things to invest in. So I'd mix it up because, again, you're investing for the next 50 years. Whatever you buy, you want to basically think it as an intergenerational asset. So you're buying beyond the current themes of the market. Industrial's hot right now. Is it going to be hot in 2040? No one knows. But if you've got a mix of good properties in different asset classes in different areas, you should stand the test of time better than others.
Yeah. Awesome. My question for you, what is the time NZ banks are going to want it paid off in 10 years or less? You probably answered that one already.
Yeah, so your amort term can be up to 15 years. You don't usually need to pay it off in 10 years or less.
The key thing to bring up as well is you can always refinance as well. If you look at every good fund manager, they use debt. Like they could have billions under management, like tens of billions. So they don't need debt, but they use debt to maximize your return. So if you've got 1 billion, it's better to have 2 billion in property and 1 billion in debt, because you've got twice the assets, twice the diversity. Your internal rate of return is going to be higher as well. It's just debt is needed essentially. If you don't use debt, you're just you're not getting the return you should.
Yeah, one of the other things to consider there is that if we are refinancing or reapplying, that can be a good time to pull equity out, especially if you're looking to grow the portfolio.
Cool. Next question is around that kind of New Zealand. Seems like we've got some Aussies on the call. If we're buying something in New Zealand, are we getting the loan in New Zealand or getting the loan in Australia?
Depends what asset you're lending against. So if you are lending against the commercial property in New Zealand, the loan needs to be approved in New Zealand. Not very common that banks will take a mortgage or a lien over an asset in another country, because it's a pain in the ass to recall it and sell it if they have to. If you are lending and you're using equity from your, say, owner-occupied property or maybe your residential portfolio in Australia, you will need that loan approved in Australia. You then bring the money to New Zealand, and then you get the rest of the loan or the balance of the loan, that's 65%, you get that approved in New Zealand.
And if I'm an Aussie buying in New Zealand and I'm coming with the cash and the way you described the lending before as it's based off the deal, am I discriminated against as an Australian at all compared to a Kiwi, or is it just the deal's the deal?
No, so certain banks will take 100% of Australians' income. Most banks do shade it a little bit. It is not the same as, say, income from the United States or from England, because they perceive that to be far more risky. The income generated in New Zealand, though, no, you will not be penalized because you are overseas, right? So if we're taking 100% of the commercial property income, whether you are based in New Zealand, in the commercial properties in New Zealand, whether you are based in New Zealand or overseas, that will always be taken at 100% or whatever the bank is taking it at.
Cool. Okay. Maybe, Scott, probably not expecting me to ask you an accounting question, but you did allude to it before. If you're an Australian citizen buying commercial property in New Zealand, should you have an accountant in New Zealand?
Yeah, well, I am. I think, look, there's some great accountants in Australia that are very internationally focused. My one's incredibly good in Australia, but admits, and it was his advice, go talk to a Kiwi local, basically. So that's what we're doing. So yeah, I think having contacts in the country, like your lenders in the country, the accountant, your lawyer in the country, like you're better off using locals to do local purchases, I think.
Yeah. There's a question going, will the rent remain in a New Zealand bank account and an Australian bank account? I'd assume for the ease of the tenant, the money should get paid into a New Zealand bank account.
Yeah, that's correct.
And then after asking 4 questions about Australia, he's then made a question going, I'm from Australia. I worked that out, Chris. Cool. A few more to go. Have any of your clients lost money from a purchase you guys recommended? Was it down to not having enough buffer to ride out the vacancy and having to sell? Good question.
I don't believe I've ever had one sell for a loss. Where people have lost money is if your tenant, it's the no income coming in for a period of time. That's what happens. And that's the advice I give you. Like, you will have a vacancy at some period. Like I've had a few. Like, you're generally working off extremely good occupancy rates for commercial property, especially because we get to choose the top 1% of properties out there. But eventually, a tenant will outgrow the space. You're going to have a vacancy come up because, a business has failed. Like my second supermarket I bought, there was a divorce, and they literally, this is IGA. So I've made your business, and they just closed up shop, and all the, perishables perished, like they didn't, so they lost like $50,000 of goods.
Wow.
And it took me 4 months. My property manager called up Foodworks, a direct competitor. They said, yeah, we want that site. But yeah, it was still 4 months or even 5 months of lost income in that period. But then we negotiated a 10-year lease, and it all worked out well in the end. But yeah, you will lose money short term when you don't have a tenant. But it's been such a good market. Properties are going up in value. As long as you don't sell when it's vacant, you shouldn't lose money.
Yeah. Cool. All right, gents, we've been going for over an hour and 20 minutes. So let's do some speed answers to knock out these remaining questions. Mike, one for you. How does the lease term influence the loan when applying?
So long as the tenant is good, the longer the better. But generally for investors, it has some impact, but it's not going to limit it. Like it's not often a bank is going to cut you off at the knees and go, the lease term is 2 years, so we're only going to give you 2 years on the loan.
We'll skip that next one, Ravi, because we've already answered it. Are you required to set up a trust in New Zealand in order to purchase as an Aussie citizen? What are the additional tax implications for purchasing in NZ as an Aussie citizen? Matthew, I'm surprised you haven't jumped behind us. He doesn't want to buy.
You're not required to set up a trust to purchase
the really simple answer right here is you Google Lighthouse Financial. There is a contact us. You book a time with an accountant, and you have a chat about your obligations with an accountant, because they'll talk you through their situation in 15 minutes.
And we've got a team of accountants here who specialize in property tax, and we've worked with hundreds of clients in Australia, so we're a natural fit.
Cool. Next question. What are the mathematics in checking that the building you're looking at buying is actually a good deal? How does the math work? Can you spell it out? I mean, you ran through those examples in terms of the numbers.
So yeah, look how it works. You look at the average build costs for specific asset classes. There's a lot of data out there in Australia and New Zealand for that. It changes month to month, but you can see the average build cost for industrial, retail. You might double it for medical because of the fit outs involved as well. So you just want to do the math and go, if I was to start this again, how much would it cost? You're going to also have it in the valuation as a replacement value, because that's part of the insurance. If the thing burns down, they need to know how much is the building insured for. And you don't insure it for the value you're paying for. It's the replacement cost, because and that's one of the things that's another thing that goes wrong when we look at due diligence. Everyone's got outdated or flawed replacement value in there because build cost went up 41%.
Yeah.
So that means they're all 41% behind if they're just renewing their insurance. So
I don't like it when you keep saying 41%. Makes me depressed. When people go like 7% inflation, building inflation 16%,
Yeah.
I can handle that. When people like kind of work out the total over 3 years, really gets me down, Scott.
It's a bit rough.
Yeah. Next question, Mike, can you use the equity from your residential property portfolio to fund the deposit, or does it have to be cash?
Yeah. So absolutely, you can use the equity so long as the equity is based in New Zealand. So if your residential portfolio is NZ based, we can lump those two at the same bank or use the equity. If you are Australian based and your resi portfolio is in Australia, you're going to have to borrow the money in Australia and then transfer it to New Zealand. So it's going to have to be cash.
Nice. And last question from JT. How much would you budget for legal fees? I'm imagining it is a massive cost, Scott.
It does vary between it. So like for a 1 million deal, it might be $5,000. For 2 million, it might be 7. For 3, it might be 9, 10. Look, it's not that bad. It's going to vary depending on how many leases you've got and what extra DD you want to do. So lease reviews are a natural extra contract review because a legal commercial lease is like a contract for a property. It's a whole big document. You can't not review those. If you forget to review that and then you think that maintenance is covered, but it's not, you could you might be overpaying by many hundreds of thousands. So it does vary, but they're rough guides.
Cool. All right. We are all done with the questions. Scott, you've also you can be. Oh, don't tell me there's questions in the chat, Ravi. Have you?
We can run through them quickly if you like.
There's quite a few. Okay. What we're going to do with the questions that we haven't answered is we're going to do a bonus podcast with Scott tomorrow. Now, the only way you're going to see that podcast is if you subscribe to Checks and Balances, which Ravi will drop a link into just so you don't forget. Scott, you've had a big day flying over and then you spend some time with us tomorrow. So we should probably get you out of here and get a little bit of dinner. If you are thinking about looking into this more, Rethink Invest, reach out to the team. If you are looking for mortgage advice, Lighthouse Financial to discuss the lending piece, because it's definitely a little bit of a chicken and egg in terms of where do you start. Thank you very much, gents. This has been fun.
Yeah.
Cool.
I've also just realized of all the people in the room, we're outnumbered pretty heavily, Kiwis versus Aussies. There's 5 of us and 3 Aussies and only 2 are Kiwis.
Yeah. And the good looking ones are Aussies too. All right. We'll catch you next time.
Cheers.